The wealthmanagement.com Advisor Innovations podcast is sponsored by LPL. As financial advice continues to evolve, LPL is at the forefront. Whether it's growing your RIA or building an independent practice, advisors can pick the business model, services, technology, and product mix that best meets their clients' needs. As a top wealth management firm 100% dedicated to advisor success, LPL looks forward to learning how they can help you build your tomorrow today. For information and show notes, go visit lpl.com/advisor innovation.
Hey, everyone. Thanks for joining us. This is the Advisor Innovations podcast. I'm David Armstrong, the editor of wealthmanagement.com. This is a podcast that simply gives me an excuse to talk to interesting folks moving the wealth management industry into new and interesting directions. And today, I'm thrilled to be joined by James Hughes, who is the head of investment advisory lending at Live Oak Bank. James, thanks very much for joining us.
Thank you, David. Appreciate you having me.
Yeah, it's great. I think the impetus for this conversation was the recent news that Live Oak crossed the $1 billion mark in advisory lending, which was pretty exciting stuff because I seem to remember Live Oak Bank being one of the earliest firms to start lending to RIAs. Could you just give us a little bit of the background of Live Oak, how you guys started? It was early in the industry, as I recall, and where you're at now.
Yeah, thank you. Appreciate that, David. So Live Oak, I'll give you the short version. Started in 2007 with the aspirations to lend to small businesses and really to lend to veterinarians. And that was going to be our whole focus back in 2007. And we did that for about 3 years. And then our customers started to say, well, I have a friend who's a pharmacist. Can you help the pharmacist? And so we ended up moving into several other industries. And it wasn't until our CEO went on CNBC to speak about small businesses in America that he met a financial advisor. And that financial advisor said, hey, you're really missing the boat here. You should be lending to investment advisors. And so in 2013, we started lending to investment advisors. And since then, Live Oak's grown tremendously. So as a whole, we are a bank, FDIC insured, located in Wilmington, North Carolina. We lend nationwide into 33 different industries, just like the investment advisor group, fairly aggressively. So we really understand the industry and we lend nationwide. We do also have a group of general lenders that will lend into any industry, but they're in their certain locations. So we have about 25 or so folks that sit in those seats. So yeah, we've grown a lot. We went public. We're listed on NASDAQ. We're about a $9 billion bank. And the aspiration for the bank today is to be the nation's best small business bank. And that's where we're continuing the charge. But my role is, as you said, the head of the investment advisor lending team here at Live Oak. And we have a sales team of 5 people, and we have a group of underwriters and closers, and then our servicing team. And all of that sort of sits under my responsibility. We lent our first dollar to investment advisors back in 2013. And we're sitting at crossed 1.1 billion in lending this year. So it's a lot of loans. And I know I'm kind of going on here, but our bank has grown a lot in a lot of different ways. And our team is just, fits into that just the same. So we are the nation's largest SBA lender. And we still hold that title. We lend more SBA dollars than any other bank in the country, in front of Wells Fargo. So it is quite a title to hold. But as we've grown, we've started to lend more conventional dollars as well, and that's really where we've seen growth, not only at the bank level, but inside the investment advisor community. And it's been really great to see that because the SBA has very black and white rules. And just as an example, if you're going to do an acquisition, you can use an SBA loan, but the seller has to exit the business after 12 months. And so as I'm sure we'll get into, succession planning as an example, if the seller just wants to sell a portion of the business, you can't use an SBA loan. So as we've moved more into conventional, we've been able to do more around succession planning and different types of structures around acquisitions. And then just the last point I'll bring up is the SBA also caps at right around $7.5 million is sort of where you could lend using SBA dollars.
Mm-hmm.
And so as we've moved up market in our business, servicing the larger RIAs and registered rep folks inside the broker-dealers, we've been able to do larger loans. And in the last 18 months, we've put on probably our largest 10 credits. And in March, we closed our largest deal ever at $60 million. So the bank and our team has really grown a lot. And I know that was long, so I apologize, David.
No, that's great. That's a great history. And I guess it kind of reverses the way that I thought that it worked, where you start, I know you've quickly outgrown the SBA guardrails, right? And got out of that environment, or maybe you're still in that environment, but I know that you quickly outstripped that and moved into bigger deals. I thought that the earliest loans were for pure acquisition and the later loans were for succession planning. And I guess that's the truth, right? The earliest loans were, it's interesting that you come from, that it was started originally for veterinarians and doctors, because there's really very little difference, right? These are asset light, non-tangible assets, businesses, really no collateral except for the cash flow of the business. And so that's a different, pardon my pun, but a different animal to loan to, right? There's different ways of evaluating these businesses. So, but there are similarities between veterinarians and RIAs in an odd way, correct?
Yeah. So the veterinarian space, the dental space, pharmacy, a lot of that is commercial real estate. So the bank as a whole does a ton of commercial real estate. We do a ton of construction for commercial real estate. Our team sits inside of a group called professional services. And so we lend to property and casualty insurance firms, CPAs, and also law firms. And so you think about the correlation between those groups is exactly what you just said. Asset light, intangible assets. It's not no real physical asset or collateral that these businesses have. They're all cash flow based lending. Mm-hmm. And I just want to touch on the one point you brought up is, so we've done mainly SBA for 7+ years in the investment advisor space. Mainly like 95% plus each year was SBA. Last year was actually the first year that we lent more conventional dollars than SBA dollars in the investment advisor space. And that trend is actually continuing this year. So we're more of a conventional lender in the investment advisor space than we are an SBA lender. But our portfolio has always been somewhere between, 65 to 75% succession and acquisition. Mm-hmm. And so the way I think about it is really the deal structures have evolved a lot. At least the ones we've seen, so early on it was, it's an asset purchase. I'm buying out, this person's business and they're going to retire within 6 to 12 months and they're going to a little transition period and then they're done. And now as we've moved probably in just looking at some larger deals and more sophisticated customers, there's more mergers, there's more acquisitions where they want the seller to stay on for a longer period of time.
And what about succession lending for internal transitions? Is that something that's kind of faded a little bit, or, 'cause I get the sense, listen, your firm has in many ways grown with the industry, right? So the way that the industry has changed, obviously you're responding to those needs. And you're right, the deals are bigger. The deals are more corporate in a way, right? These are full-on corporations buying other corporations at this point. What has happened to the Gen 1 to Gen 2 to Gen 3 succession planning financing?
Yeah, I appreciate that lead in. I actually feel really good about where we are as a bank and our offering to the investment advisor space. I came to Live Oak in 2013. I got on the investment advisor team in 2015. Since being on in 2015, this is really the point where I feel like we have the best product set for the industry. We're offering lines of credit, working capital, recruiting dollars, succession loans, acquisition loans, commercial real estate. Really, if there's anything that an advisor needs, we're providing financing for it. So I feel really good about where we're at. Mm-hmm. And then, as you said, I mean, we've really grown with the industry where we've built products, and either if they're not market, right, we're seeing other people out there providing, better terms or different terms. We're changing on what we're offering. And then, we're looking to continue to, improve the product, bring a better product to the advisor community, day in and day out. A perfect example is internal succession deals. The way that was sort of the preface, the way that was built internally was initially, this is a little bit in the weeds here, but initially it was a 5 to 7 year term for a junior or G2 to purchase equity in the business. And we've moved mainly to a 10-year product. For some of the smaller firms, we'll use a 7-year, but it's mainly a 10-year product for G2 to buy in now. And that has been tremendous for our business, and also for the level of customers that we've gotten. Last year, we probably did more succession deals, like internal succession deals, than we did acquisitions. And I think it was, the market, right? I mean, it was the impact that cap gains was going to have. It was, the market was up, valuations were up. And so we saw a lot of, G1s take some chips off the table, and our product was definitely more attractive than it ever has been.
Can I ask why the terms have gone, right? These used to be structured as 5-year deals. I recall that, right? Take 5 years to slowly move in G2 to the ownership position, and you guys would fund that transition. Why has this extended to 10 years? Is this because the firms themselves have become larger? That we're talking more valuable firms, so a bigger loan, more time to pay that off, or why is the term?
Yeah, so the term of the loan is is determined by our credit policy, and initially it was 5 to 7 because that's where our policy was. And what we were finding was that the valuations were too rich in order to make the payments work on a 5 to 7 year term. Right. So where valuations are today, really, a 10-year product is needed, and that's why we've moved to the 10 years, so that we could actually get these deals to cash flow, right? So that the person doing the buying is able to to pay us back with the distributions they're getting from the business. One other point I'll just bring up about that, sort of how we changed our policy a little bit, is, around the G2 doing the purchasing, we initially said that they needed to bring in some cash to the transaction. And obviously we like when our borrowers bring their own cash to the transaction, because it means they have skin in the game and all the reasons that, banks like that. But what we've realized over the years is that, the people doing the buying, the G2s, are often younger, late 20s, early 30s, have a young family, might not have, 10%, $100,000 to buy 5% of the company. And so we have loosened our requirements on the cash in component so that we can get more equity in the hands of G2.
Interesting. Can you give me a sense of, when you're examining these deals or people come to you with requests, and let's stick with succession planning for a bit, the percentage that you turn down versus the percentage that you actually extend credit to?
That's a good question. I'd say in the early days, the turn down rate was a lot higher.
Okay.
And, these days, I think it's more of, if there's a transaction to be had, then we'll likely be able to finance it. Okay. And I think a lot of the conversations that either fall apart or fall out are from, we get a phone call from G2 and they're saying, I'm going to buy 10% of my company for $1 million or $500,000 or whatever the number is. And I'm looking to do this the next, 6 months. And this is what we're thinking about for a purchase price. And then as we have that first conversation, and as we follow up, the deal just never happens, right? So G1 either disagrees with the purchase price, the valuation, or they just can't come to terms, and so it'll fall out.
Mm-hmm.
Because really, when we look at these deals, we're showing G1 and G2. So you want to buy or sell your business for, $1 million for 5%. Well, here's what G2 is going to get for a loan. It's a 10-year loan. It's at X percent. Here's the payment. And they look at it annually and say, oh man, that's the payment. And this is the distribution they're getting. And so it's either going to make sense or it's not. So we generally don't see a ton of declines like from credit score or, things that normally banks would decline people for. I think we see less and less of these days than I would say initially earlier on in our stint in the industry, we would see more of that.
And I guess the reason that I asked that is from your perspective, you see into the internals of a lot of RIA firms. And I guess I'm wondering, that if just as a kind of barometer of the health of the industry, what you see when you open up the hood, and what might be a red flag for an advisory firm to say, oh, no, bad credit risk, we're not going to touch it. And whether that's, the makeup of the book of business, the age of the client, decumulation phase, whatever it might be, if there are the normal factors that affect an evaluation, if there are things in there that often bring you to say, this is not the firm that we want to lend to.
Yeah. Well, like there's a lot in there.
There's a lot. I'm sorry.
It's good. It's good. I'd say that people that had my job would probably be surprised on some of the personal financial statements of the advisors. I think it's kind of like, the shoemaker's kids don't have shoes type of thing. I think that would be surprising. But at the same time, I think a lot of advisors realize how liquid their business really can be, in that they understand the M&A market within the investment advisor space. So like they're building an asset that they truly can sell, and they recognize that, and they're putting, like any small business owner, everything goes into the business. And so as a small business bank, we realize that. As far as, when we look at the businesses or just industry as a whole, is in a really good position. I think that what we're concerned about, or what we think about is that, the aging population of the advisor and getting the assets into G2's hand, the next generation, all that sort of stuff. But from an industry standpoint, we've lent $1.1 billion in loans, and that's over like 1,300 different firms we've lent to, and have had like very little, tiny hiccups in the portfolio. So it is one of, if not the best performing portfolio at the bank.
Yeah.
And, we sit across a bunch of different industries. So as an industry, we should feel really good about where we're at. And then you asked about the firm and like what would command a premium, or what looks really strong within business. I think, liquidity at the business level is nice to have. That's, as the businesses get more and more sophisticated, that's probably more of a thing, right, than it is like the sole producer whose business account is really like a personal account, and vice versa.
Yeah. And
then I'd say, the margins in the business is really interesting, because the smaller firms, sole advisor to, 2 advisors, and in that smaller range, the margins can be like 75%, right? Really profitable businesses. As you grow from, 50 million in assets to $1 billion in assets, typically you see the margins compress. And so you just have more overhead. It costs more to have a CIO and CCO and COO, and it's just your overhead becomes more. it's still mainly employees. I mean, that's your biggest expense. But margins we see creep below, 40%. I'd say is common for it to be below that number. I think if you can maintain margin and grow your business is where we've seen some really incredible firms where you have a firm that has 5-6 billion in assets and still operates at a 50% margin. I mean, it's quite incredible to have that. The last thing I'll mention is just growth. Organic growth is king, especially in times like these where, the market isn't necessarily appreciating. So bringing on net new assets actually helps you maintain the revenue level you had the year. So growth and consistent year over year growth with a methodology behind organic growth and proven success. Certainly that will command a valuation that is above is a premium.
Yeah, showing organic growth, particularly when the market gets wobbly like it is. But you're right. I mean, a 40%, 50% margin for a small business, and even at $1 billion, $5 billion in assets, these are small businesses. That's an industry where, across businesses, that's an impressive margin, right? So you understand why this industry is attracting a lot of outside capital, which I'm sure you've come up against. Go ahead.
Yeah, absolutely. Sorry, I didn't mean to interrupt you.
Yeah, no. So I just wanted to transition a little bit to what you see. We know Live Oak Bank was early in the space, but now you got some competition out there, right? We have private equity coming in. Advisors seem to have dozens of sources of capital if they want, just because people have discovered this industry and discovered that it's a profitable one too. How do you think that has changed the landscape at all? If particularly with the private equity coming in and making these investments, has that driven up valuations to a place that might give you a little pause, or what do you think is the effect?
Yeah, I mean, as far as, our competition or having competition, I think it's good. I mean, me personally, I think it's good to have competition. I think it strengthens you got to sharpen your pencils. You got to be really good at what you do, have a good value proposition and, sell the heck out of it and just, always be out there and hit the ground, running. So I don't mind competition in the space. I think it's good for the customer. It's good for the advisors to have competition. And then as it relates to private equity, yeah, I mean, I think that they have driven up valuations, and not to, say anything. I'm not saying anything bad about private equity. It just, it is, and it's not just them, the whatever the them is, it's really just been demand. I wouldn't necessarily push, blame on anybody, but it's just been the sheer level of demand that's really pushed up the price. And, I mean, it is the biggest thing I think that has impacted us, Live Oak Bank, and our day-to-day is just the misconception about valuation.
Yeah.
And how you have an owner that owns $100 million firm that sits inside of a broker dealer, and they want to get paid, 4 times revenue or 10 times EBITDA, and the business hasn't grown at all, and all their customers are 80 years old, and so really sort of dialing into the valuation and how these firms are getting a really high premium, what they look like. I think that's where the next level of education is going to be helpful, because there are some really big numbers being thrown around. Yeah, I mean, I've heard 15 to 18 times EBITDA,
right.
But the firm that we're talking about probably had $5 billion in assets and is growing year over year at 25%. So I mean, it's just a completely, you need to look at each individual firm. You can't just take these multiples and apply it to your business, because it's just not the same business.
Right.
And I encourage people to speak with professional valuation firms and talk to them about where they see your value. And then, I mean, if you're a seller, certainly going through a professional M&A broker is if you're looking to get top dollar. I mean, that's certainly, the route to go. I think, everyone's asking, is it sustainable? I mean, are the valuations too high? I think, time will tell.
It feels a little bubbly, doesn't it? I mean, like everything else, right? It's and maybe this will be answered in the next couple of months. We'll see what happens with the economy, but it feels a little rich.
Yeah, I mean, it feels a little rich, and then at the same time, it's just that same thing where it's it's demand versus supply, right? I mean, supply is limited, and as long as demand is there, then the valuations will keep increasing, right? Because if you have 20 bidders for every deal, that's what's driving it up. If all of a sudden you have 2 bidders for every deal, then you would see it pull back. But I think in my mind, that's the biggest thing is that if you just have less buyers, that would be the most immediate impact. As long as you have a bunch of buyers competing and really wanting deals, then they're always going to be sort of just one-upping each other and maintaining a certain level of valuation.
Yeah. Do you see this changing? I'm sure you have some projections on your books, depending on where markets are, maybe more importantly, depending on where interest rates, the impacts that's going to have on the M&A in the industry. I think the conventional wisdom out there is that it's going to tank it, right? That we've reached the peak and interest rates are going to go up, and that's just going to take the air out of this entire frenzy of acquisitions that we've been seeing. Is that your take too, or where do you read the tea leaves of the future?
Yeah, it's always difficult to read the tea leaves. I'd love to listen to this podcast in 5 years and see how wrong I was. But I think that a little bit of a slowdown probably makes sense, just given, the rising rate environment, and then, market volatility causing some people to pause. At the same time, rates are still very low. I mean, if prime's at 4.75, I mean, you're still, lending at a, sub 10%, well below 10%. So rates are still good. I mean,
historically, yes. Right.
Yeah, historically. And then, what happens when there's market volatility is people that are of the retirement age probably are working harder than they've had to work in the last 10 years, either during, if they can get a good valuation, or certainly after this market volatility, subsides. I think there's going to be a lot of sellers. So it's almost like every environment that we're in, there's buyers and sellers. So I sort of see it just being maintaining, that's sort of like how we've felt this year is we're not overwhelmed with deals, but it's been sort of slow and steady. Mm-hmm. So that's my prediction.
Yeah. Okay. and slow and steady with perhaps people will say, well, obviously a wobbly market, volatile market falls a little bit. That obviously compresses the margins of these businesses which charge on assets. I think there's been numbers tossed around that even a minor correction in the market, a 5% dip or 10% dip, has an exponential effect on the EBITDA of a RIA, unless they make some internal changes, right? Cutting their costs, in other words. So the pace of M&A may maintain, but the valuations come down.
I think that right now, what I'm seeing for deals that we're closing right now, like valuations are staying constant, okay. But the deal flow has somewhat slowed. So for right now, I think because there's still, to be a buyer, you're still having to compete pretty aggressively to get the deals. Like the supply seems still, light for the amount of buyers. So I think valuations will stay the same, and it'll just, somewhat slow. Maybe I'll go back to a point you were making about the businesses as a whole and maybe impacts to these businesses. Obviously a market decline is going to potentially impact revenue, right? If they're charging off of assets under management. What we saw in 2020 with, the blip with COVID is that, there isn't a direct correlation between the equity markets and the performance of these firms. And we should hope not, right? Mm-hmm. And so therefore, the revenue isn't, immediately impacted to the same, percentage. And they're also billing, monthly or quarterly. And so their revenue sort of gets smoothed out there. They're not just completely impacted by a correction.
Right.
And this is where that organic growth thing, as I mentioned earlier, really comes into play, where if you are growing organically, then it's going to help you get through some of these times. And the way that we think about our portfolio is we're fairly conservative when we do underwriting, but the way that these firms have grown over the years with the market, with organic growth, I mean, they're well above our underwriting requirements after they've been on the books for, a year or two. The portfolio is one of the strongest, if not the strongest, from a cash flow standpoint at the bank. And then, as you mentioned, I mean, a lot of their expenses are variable. And so they have the ability to pull back if and when they need to. So really resilient businesses as well.
Yeah, interesting. You mentioned the blip in 2020. Being an SBA approved lender, you guys were right on the front lines of the PPP loans from advisory firms. Yeah, can you tell me a little bit about that? You did a tremendous amount of business, or I don't know, business is the right word, but a tremendous amount of emergency lending back in that day, correct?
Yeah, it was wild times because everything was shut down. You couldn't go into the office, and then we were making PPP loans, and a lot of banks weren't. Or talk about demand. There was a lot of demand for PPP loans, and so we set up. And the entire lending team just went to do PPP loans so that we could try and the businesses that needed it most. And so myself and our team, we were making PPP loans to, dry cleaners and real estate agents and all sorts of different businesses. But really, we tried to focus on the industries that we were already lending to. So our team, tried to lend to investment advisors, and we reached out to some of our different contacts and said, if you know people that need help, we would love to help them. And I mean, we were working crazy hours trying to get all these people PPP loans. And it was really rewarding because a lot of people really did need the capital. And at that time, I mean, it was very, now looking back at it, I just said it was a blip. But in the moment, I mean, really, there was a lot of concern. No one knew what was in store. And it was a cool thing to be a part of. And there was a ton of great stories that came out of, we did thousands and thousands of loans here at the bank. And we certainly put a lot of effort into it.
Yeah, and to investment advisors, right? I mean, they've really impacted. And then there's been a fair amount of hindsight criticism of RIAs taking PPP loans, but as you say, at the time, no one knew where that was going to go, right? No one knew what the future was going to hold. No one knew it was going to be just a blip. There was a real fear that could be a prolonged downward slope.
Yeah, I mean, I the bank doesn't look negatively upon anyone that took a PPP loan. And I mean, me personally, I don't look negatively upon anybody that did either, because, I was on the phone with these people, and it really, I mean, there was genuine concern in all of their voices, and it was available to you as the government was offering it. And so I don't see any reason that people are looking down upon somebody that took it, because again, it was just something you didn't know what was going to happen, and so it really helped a lot of people.
Yeah, Well, that's fantastic. And James, this has been great. We're bumping up against our time here, but I really appreciate your taking the time to speak to me. I always learn something, so that's fantastic. And congratulations on crossing the $1 billion mark, $1.1 billion mark. And thanks a lot for joining us.
Well, thank you, David. I really appreciate you having me, and hopefully we can do it again sometime.
I hope so. We'll see you soon.
All right. Take care, David.
And this has been the Advisor Innovations Podcast. Thanks for listening.
This podcast is sponsored by LPL Financial, a registered investment advisor and member FINRA SIPC. LPL Financial is a separate entity from and not affiliated with wealthmanagement.com.